That's it.
Yeah.
Time is running. Great. My name's Sten. I work for Tavex in the Danish branch. I'm the CEO of Tavex in Denmark. And today I'm making a small interview with Professor Krassimir Petrov from the University of Fujairah. Did I get that correct?
Yes, indeed.
This is completely unprepared interview. So we are just going to elaborate the things that I would like to hear from Professor Petrov. And I think we should come to the first question, which is, can you maybe very, very briefly, and I know it's probably extremely challenging task, but to explain the concept of money in the Western society.
Money has been for centuries, more like for thousands of years, has been always gold and or silver, as in silver, sterling silver was for hundreds of years money in Great Britain, which was later replaced with gold. And it has been only recently, mostly in between the two world wars and especially after World War II, where money has been, which was originally gold and or silver, has been replaced with paper money. And paper money has been for a while backed by gold. In other words, that would be the Bretton Woods system, where the US dollar will be backed by gold, and then all the other European and other currencies would be backed by the US dollar and indirectly by gold. And since 1971, the dollar has not been backed by gold. Convertibility of the dollar has been severed from the gold, and therefore we have pure fiat currency. Fiat means that it's not backed by anything, it's just pure paper money. Which means, of course, the governments can print as much as they want out of it, as long as there's some confidence in the money. They print it, they spend it, they finance their deficits, they finance their wars. So, since 1971, almost 50 years now, we've been running on a pure paper standard, except a little longer was the Central Bank of Switzerland, which had the Swiss franc backed by gold, which is no more.
Yes, thank you. Some people would object to that and say that correct me if I'm wrong, then in 1971 it was the year when gold was disconnected from the money supply in the United States.
Yes, on the August 15th.
August 15th, very good to know. But people who would like to oppose your point of view would probably say that in 1971 the world was at a stage where the monetary policy at that time did not meet the needs of the society anymore, because gold as a very, very limited resource was not able to match the need for the supply of money. Well, what would you say to people who claim that?
Yes, this is absolutely true. It is absolutely true that the limited supply of gold limited the amount of money, and the limited amount of money limited government's ability to spend and government ability to finance themselves with printing money, and limited the government's ability to issue debt, to accumulate a mounting of debt, and to continue with ever increasing amounts of debts. This is absolutely true. This is absolutely correct. But the problem is exactly that since we have removed this restriction on the government debts have been going higher and higher and higher and ever higher, and they only accelerate and accelerate, where right now the whole Western world is swimming in totally and completely unrepayable debt. That includes the US as well as the UK. Of course, we already saw what happened with Iceland and Portugal and Greece and Italy and Ireland. In other words, practically the whole Western world is so deep in unpayable debt, and this is a consequence of having paper money and the abilities of which allows for government to borrow as much as they need and to print whatever else is necessary. So it's actually paper money is the root of most evils that we're facing today.
So, what would be a good solution? Because again, as an opposing party, I would say that the society has developed even further from 1971. And do we even have the option to go back on gold standard, or what do you see as a solution to that problem?
Yes, we always have the option to go back, and we always have the solution. The problem is who benefits from this solution and who loses from this solution. Yes, the best option and the best solution is returning back to the gold standard. And the stricter it is, as it has been in Great Britain in the 18th, especially 19th century, the better it would be. The problem is that this gold standard will strictly limit government's ability to spend, government's ability to borrow, government's ability to run up deficits and debt, and therefore the biggest loser would be governments. Second, it would prevent banks from creating credit out of nothing, unbacked credit, unproductive credit. It will prevent financial speculators, including major commercial banks and especially investment banks, to grow bubbles, financial bubbles, stock market and bond market, real estate, commodity bubbles, to profiteer from those. So they would be most distantly the losers in a gold standard, and they will fight to the death that gold standard never sees the light of day again, that we never readopt the gold standard. On the other hand, the winners will be people, ordinary people, hard-working people. The winners will be small businesses and possibly mid-sized businesses. In other words, the good, honest, hard-working people and businesses will tremendously benefit. That will be 95 to 98% of the population will tremendously benefit. It will even the playing field against bigger and smaller players. And indeed, that will be highly beneficial for the health and strength of the economy. That's how America, for 100 years, on the gold and silver standard, became from one of the least developed or underdeveloped countries in the world. It was just a prairie, empty, became the world's foremost power. Similarly, that's how Great Britain, through trade and industrialization, became the world's foremost power. This is exactly how in the 1860s or 70s, Japan, by introducing gold money and a number of other social and economic and educational reforms, became the second and third greatest economic military power in the world. In other words, all great societies have become great with and through the gold standard, including Russia. During the old czars, they were only and entirely 100% based on gold.
Thank you. We have talked about a few things. What, in your opinion, are not exactly in place in the financial system. One of them is that you see a problem that the current money that we have is a fiat currency, not backed up with physical commodities, for example.
Yes,
gold.
Indeed. Well, we also have to clarify a problem for whom. It's certainly not a problem for commercial banks. I mean, they're profiting, they're profiteering. Certainly not for major stockholders. Stock markets are all-time highs. Certainly not for the rich. The rich are benefiting tremendously. We are most certain that for the last 10, 20 years, the rich have grown a whole lot richer, and the middle classes have been quite impoverished. So for the top 1%, it is working remarkably well. It is working as designed to benefit them, but it is not working for the 99% of the people, and they are the victims of this. So it is very good for the few and very bad for the majority of people. So coming back to your question again.
Yes, what was that? I would like to know what are those things which, let's say, are profoundly wrong in the financial system or regulated incorrectly. For example, we established the fiat currency issue already. The other thing is we established that the banks can create money out of thin air. That's a multiplication factor. But what else could you point out?
Well, no, these are the two fundamental problems. The question is, what are the consequences out of it? If the government can borrow and then borrow more, then the government, most of government spending is unproductive. It goes to wars. Iraq, Afghanistan, name a war, it's financed by printing money. In other words, government credit is used highly unproductively. It's mostly used for wars, we call this warfare, and we use it for welfares and paying people not to work and stuff like that. So most of government spending is almost entirely unproductive. Most of bank credit is currently unproductive. Instead of financing highly productive enterprises, business, manufacturing, and so forth, they finance speculation. They finance speculation in stocks, bonds, real estate, derivatives, which has absolutely nothing productive when you speculate on the economy. And it's a speculation on a massive scale. So these are highly damaging. Third, as both governments, central banks, and commercial banks manipulate interest rates lower, low interest rates do not provide important pricing and economic signals. And you cannot judge which investment is good with a high return and which is not so good with a lower return. When interest rates are suppressed, you cannot judge which businesses and enterprises and projects are very high risk and which are relatively low risk. In other words, interest rates have the important function of moving capital around to its most productive purposes with the lowest risk. This function of allocating capital is damaged significantly where capital is not anymore allocated to its most productive purposes, and therefore could be used in unproductive enterprises and losing enterprises. It can't pay for itself, and therefore scarce capital in the economy is simply wasted, which means growth is slower, profitability is slower, and therefore salaries are slower and society is significantly worse off. In other words, the capital markets don't work as designed and appropriately.
But your opponents would say at the same time that the negative interest rate for deposits for commercial banks in the European Central Bank is actually introduced because of the reason that more money would flow into the economies and that the local, or let's say domestic commercial banks wouldn't have the interest to deposit money, and this is considered as one monetary policy instrument to stimulate the economy, and so that the capital would flow to the businesses and or sectors where it's really needed, and to motivate banks to borrow money to its customers.
If it is really needed, they would be paying willingly 3, 4, 5, 7, or 8% willingly and eagerly, and you don't need to suppress the interest rate down to 0. If they are willing, if they're profitable, if they can generate return, they pay 5% like they have been paying for the last 2, 3, 5, or 700 years, depending on the history. Much longer is the history of Amsterdam, okay, and maybe 300, 400 years of in London. So they have always been able to pay historically for the last so many hundreds of years, that now what has changed now that they can't anymore, and that they need to suppress the interest rate down to zero. In other words, there is something fundamentally wrong currently in the economy when something has worked remarkably well for hundreds of years, but somehow it doesn't work now, and they need interest rate at 0%. Second, just because they can get a cheap credit, which for them is a benefit, doesn't mean that there are no losers. Retirees lose, investors lose, savers lose. In other words, if all the borrowers benefit, then all the savers lose. And for every borrower who benefits, there is on the other side a saver who loses. So as much as benefit accumulates on the one side of the borrowing, this is exactly mirrored by the same loss on the other side of saving. So it's essentially, this is all you're doing is you transfer wealth from savers and investors to borrowers. There's no net social benefit, but there is clearly a net social loss because the capital allocation process is broken to the point where capital is not allocated where it's most needed and most productive.
I'm very glad that you mentioned savings, and probably in Denmark, for example, as far as I know, and I cannot back it up with any data, but as far as I've heard, this is the nation in the European Union who has the most savings.
The most, my understanding, is the highest private savings.
Private savings, yes.
Correct, because and when it comes to the nation with the highest public savings, that would be Norway. Okay, mm-hmm. Correct.
And this leads to my next question, that we talked about negative interest rates. As far as I understand, those two not apply for private savings at the moment, because as far as I know, there are no banks at least in Scandinavia, who has implemented negative rates for private persons.
Right, but they still pay like zero, right? So if you're a saver, you get nothing.
Exactly.
Or close to nothing, close to zero. Correct.
Another thing, what we are hearing from the media every day is that the biggest effect, the biggest negative effect, what can have an impact on your savings is inflation.
Correct.
Could you please explain in a few words, how does inflation affect me as a private person and my savings?
Well, it's very simple. If prices go up by 5% and your salary stays the same, you simply lose 5% purchasing power. It's that simple. If you have, let's say, 100,000 in the bank, and with it you can buy so many cups of coffee, if the price of coffee goes up, your money earns zero, you're going to be able next year to buy less cups of coffee. If you have 1 million in the bank, and 3 years ago you could buy, let's say, 3 apartments, now you can buy only 2 apartments. So you're losing money. Let's rephrase in terms of the Danish saver. Danish saver earns nothing. Well, who benefits? On the other end of the Europe is the Greek government, the Greek banks, the Greek borrowers. They borrow at almost zero, and therefore they are the huge beneficiaries. Well, how do the Danish finance the Greek? With the higher house price. They could buy a house for 100,000 euro otherwise, if interest rates were normal at 7, 8, 10%, as they usually are. But now at interest rates close to zero, they can borrow 2 or 3%, and they buy the house at €250,000, or maybe €1/3 of a million, €500,000. In other words, they are paying now twice for their house, because this is a distortion in the monetary policy, which suppresses artificially interest rates and borrowing costs and artificially inflates the price of houses. So the Danish citizen pays for the Greek bailouts through higher housing, through higher assets, through, in general, higher inflation. Inflation in general is bad for people because they lose purchasing power. For the same amount of money, you always want to buy more. And with inflation, you always buy less, and each year buys you less and less. So people and savers are distinct losers, and in Europe, the biggest losers are private Danish citizens who save.
So, is it correct to say that if one has savings, then one should be actively involved in finding better profitability for your savings? Or you don't recommend keeping any?
There is no better profitability anywhere in the world. All interest rates are currently suppressed close to zero. All European interest rates are down practically to zero. American interest rates are barely 1.5, now 1.75%, like nothing. Japanese are practically zero. 3 or 4% is in China, but extraordinarily high risk. Because of this general global centralized monetary policy, where all central banks in the world jointly suppress interest rates all over the world, there is no meaningful return anymore in bonds or in bank deposits. Practically everywhere, as a result, real estate is extremely overvalued and not a good return and not a good investment anymore. Stock markets are in bubble territory practically all over the world. So at this point, there is no meaningful investment except for simply parking your money in stable and solid values, as in commodities. That will include copper and steel and zinc, and the best commodities throughout history have always been gold and silver respectively, because they have somewhat better properties than copper, zinc, or rice, or milk, or cheese.
But as we are in the business of handling physical gold, people would say that handling commodities is expensive because of the transaction costs, yeah, and why shouldn't one look into different derivatives which are basically connected or binded with
Or let's rephrase. If a transaction cost is 1, 2, or 3%,
yeah.
Try stocks. Stock market just crashed 4% one day, one single day. It's down 4%. So if the transaction cost is a percent or two in your case, or 3%, again, that's a reasonable cost to protect some part of your portfolio. Now, if your transaction cost will be 10 or 15 or 20%, that's totally unreasonable and unacceptable. But a 2 or 3% is a reasonable transaction cost. Similarly, like paying 2 or 3% of insurance cost in a house is a reasonable cost of insurance, or 1% will be a reasonable cost of insurance. Again, there may be other alternatives, but they're not, as in paper assets, they're not really great. I mean, anything can happen and your ETF can be gone, or the ETF price might not keep the price the same as physical gold. Also, if there is a financial crisis, if you have other instruments similar to gold, but not gold itself, if the financial system is affected, your instrument being part of the financial system will also be affected, as Greeks discovered a few years ago when their banks and financial system was practically closed, shut down, or frozen completely. As during the global financial crisis, high up north, Iceland and Icelanders discovered, just like far down south, Cyprus, the Cypriot people discovered. It is not a reasonable protection. The only reasonable protection will be hard assets and cash outside the financial system. And hard assets, we usually mean gold, silver, well, additionally, possibly platinum, palladium, meaning precious metals, and cash, banknotes outside the financial system. When the whole system is frozen, you still have money to pay your electricity, your food, and whatever else you need to pay. And you need to have some cash, at least for 2-3 months of living expenses, and you need to have at least some gold for maybe 2 years of living expenses if things get really bad, just in case. But ideally, people should keep a quarter of their overall wealth, even as much as a third and up to a half, depending on different circumstances. That's a very different topic of how much to keep of your overall wealth. They should keep in cash, gold, and silver outside the banking and financial system. And they can still keep a third in real estate. They can still keep a third, let's say, in stocks. Nothing wrong with that. What would be wrong is not to have some cash and gold outside the financial system, a quarter to a third.
I also think there's one thing which is also a pretty good insurance for times of crisis, and that is children.
Well, in times of crisis, best insurance are guns and bullets. Let's be clear about that.
It depends what kind
Tell
of
me
crisis.
about the children.
But actually, that leads to my next question. Do you personally believe that in times of crisis, where, for example, the access to the financial system is very, very limited, there is limits on cash, etc., etc., people still accept precious metals as a means of trade?
Yeah, of course. Well, first of all, we already know. I don't need to think. We already know what happened in Iceland. We saw it 10 years ago. We've seen it on TV. We can see it in the news and whatnot. So that one is perfectly clear. We also saw this 5 years ago in Greece. We also saw it just as many years ago in Cyprus. We don't need to think and hypothesize. We know. We observe. We can watch it on TV. So it's crystal clear what happens. At that point, other things begin to circulate. As I was explaining in my lecture yesterday, even in Bulgaria during 1997 crisis for 6-7 years during the hyperinflationary years, as banks were having problems and they eventually shut down and the currency was all gone. The three things that worked were Deutschmarks, US dollars, and gold. Whatever you can get, whatever you can get your hands on, whatever you have, it will be all widely accepted. This would be pretty much the only money in circulation and acceptable in the economy. So these are the things that we observe commonly. Most of the times in all sorts of African countries which get in some sort of a crisis, the financial system shuts down. It's all down to dollars and gold.
And is it only because of the gold's high value, historical reasons, or there are some other reasons why people still return to gold?
Well, they sometimes do return to silver, especially if they have silver money, especially if they have silver coinage and other stuff. Gold has been money for 5,000 years. Anywhere in human history and in human civilizations, whenever gold has been discovered or appeared, probably through trade, that particular society has adopted gold or silver as money. It's simply because gold or silver have these amazing chemical properties. They're easily recognizable. You can cut them, you can slice them, you can mint them, you can do a lot of things. You can melt them, you can remelt them, and so forth. Especially gold, doesn't rust, doesn't spoil. You can lose a Roman gold coin 2,000 years ago in the water. You picked it out of the Mediterranean. It's still beautiful, bright and shiny, just the way it was minted 2,000 years ago. No rust, no nothing on it. So gold has these beautiful properties. Example, we have in Bulgaria a church very well known with a golden cupola, just like you have in the Kremlin in Moscow. They have been golden or gold plated how many centuries ago, and they're perfectly bright and shiny in same condition as they were a few hundred years ago, and you can see them from hundreds of kilometers far away. In other words, these are some extraordinary properties which gold and only gold possesses, and that is the reason pure chemistry, physical properties, that makes gold so much more better than anything else. And second to it is silver. Now it's a whole different story. Silver, many societies have preferred and chosen silver for money, like the Chinese. Most of Chinese civilization has been almost entirely based and run on silver, like British. The British has been, and British sterling pound was 1 pound of sterling silver for a long time until they lost all the silver. It's a very different story why they were forced to switch to gold, but they do have the properties, so whenever a society discovers them, it adopts them because of their convenience and other things. They are better suited for money than anything else in nature.
And thank you. We have talked about a little bit what kind of concerns should a private person have. But if we take a little bit higher helicopter view, this is my very last question on the current financial system, and maybe on the macroeconomic situation of the Western society, then my question is simple: do you see some light in the end of the tunnel with the current financial system, or there is
Yes.
only a doomsday solution?
Well, it's both. It's the doomsday scenario first, after which there is a major cleansing process, and then you rebuild all over again. This is exactly what happened in my home country of Bulgaria. From 90 to 97, things were getting from bad to worse to a complete social, meaning first monetary, banking, financial, and social collapse, crime and everything. In 97, actually 98, we had a monetary currency board. We restarted without debt all over, with restrictions on government debt, with restrictions on printing money, with the local currency backed first initially by dollars and later on we switched to and the economy was rebuilt. We are now 10 or 50 or 100 times better than what we were exactly 20 years ago in 1998. In other words, we were as if destroyed by a war, eventually actually a whole lot worse than that, and now we are infinitely better. We got banks running and operational, whatever their problems might be. We got the roads, we got the businesses. People are earning infinitely better. You can't find a single person without a smartphone. Practically everybody's got a laptop, practically everybody's got a BMW, a Mercedes. In other words, we are doing remarkably well after the crisis. But it was the crisis and the cleansing process that set us on the path to a major growth. Yes, we have some political corruption problems, we've got other things, but people, businesses, everybody is infinitely better than we were 20, 25, or 30 years ago. And this is exactly my expectation for the rest of the Western world. First, there will be dark It's going to be a doom. There's going to be major, possibly financial chaos. Hey, best example is Iceland. Things were bad. Things were horrible. The kroner collapsed. Banks were closed. Things were really, really bad in Iceland. Well, Iceland emerged first of all European countries, growing fastest and in many ways healthier than the rest of the European economies. Now, here's a second, exactly the same example and lesson. In the whole world, the economy that crashed the worst during the global financial crisis, you may be totally surprised, with the biggest dive, the biggest collapse was in Singapore. Surprise. However, the crash was the worst, the crash was the fastest, and Singaporean economy bottomed out first in the world and began to rise fastest in the world too. It recovered better than most other economies. So there is a light after the crash. And the worse the crash, the better is usually the restart afterwards. It's like the big fat guy. You get him on a 2-month diet, he slims down, and then he's young and strong and healthy once again. And so is with the financial system and the economy.
Thank you so much, Professor Petrov. We have exhausted the time that was in our hands, and also my questions. So thank you so much for coming and talking about the economy and some of the commodities as well.
Thank you very much. You've been a great interviewer and a great listener, and I'm looking forward to having an interview with you again. Thank you.
You too. Thank you.